This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story, Target just said the unthinkable is happening. We'll show you what's going on at Target and why this is bad news for retailers all across the country. And is the government cooking the books once again on unemployment claims? We'll show you what their latest move is and why unemployment claims are about to surge higher. And is the Fed going to crush retailers? We'll show you why the bond market says there's more pain for the retail space ahead. And speaking of pain, manufacturers have a big new problem. The challenge is, this one's not good news at all for the U.S. labor market. Now let's go to Bloomberg, where he picked today's story up with a headline: U.S. retail sales missed forecast after steep drop in the prior month, as we now see purchases increase a massive 0.6% in February, boosted by cars as consumers go and hit dealerships nationwide. But one of the challenges we face here is the retail space, because this is where we look to consumers to find out if there is indeed demand. One of the challenges with data today is everything's getting revised down. So the question is, do we buy this report after we just saw the last month's report get down revised heavily? Or do we believe that there's a turnaround going on? Here you can see last month revised down to minus 1%. That is a staggering drop. As you can see, usually only happens during major slowdowns. Of course, that was backed up by a big increase of 0.6%. We'll find out next month if that holds. But under the surface, Thursday's report points to a consumer that's growing more discerning, and that's a problem. As the labor market starts to cool somewhat, a case we've been making on the show is going to be a huge problem and only going to get worse as credit access becomes more limited and higher prices continue to bite. And these are all big problems for retailers, because we continue to hear the U.S. economy is strong and robust on the back of our labor market. And what we're starting to see at the retail level is that maybe the labor market isn't as strong and the economy isn't as robust as everyone thinks. Because when we take in account inflation, which is important for retailers, we look at advanced retail sales less inflation or the consumer price index shown on a year-over-year rate of change. And you'll notice when you head into recessions, something happens, is inflation adjusted or real retail sales goes negative. Now, this is a big problem for retailers, because what they need is retail sales to stay ahead of inflation. They make money. They need to see profits and revenue that are actually sustainable. And if inflation is eating into their sales, that's a big problem. And we can note that despite that big 0.6% month-over-month increase that the BLS said, well, what we can note is on a year-over-year rate of change, real retail sales have been negative since 2022 and are remaining that way, suggesting that there's something wrong with the U.S. economy that the political elites just seem to be overlooking here. And that is very obvious, because we note that the problem is there is issues with the U.S. labor market, and more importantly for consumers, there's accessing credit. And that's a big deal, because retailers rely on consumers buying things they don't need with money they don't have. And right now the banks are saying, well, you can't have more money, or at least not that much of it. As we look now as real retail sales, still shown in blue, against the net percentage of domestic banks tightening standards for credit card loans. And what that means simply is consumers look to push up their limits or to get new cards with more balance to spend. Banks are pushing back, either not allowing credit or only allowing a limited amount. That's what happens when banks tighten standards. They make it harder for people to get credit. And here you can see that banks are tightening anytime that red line is above the horizontal black line. And sure enough, what do you know? Going back into the mid-1990s, what do we see? Tight credit standards lead to, well, rather flatlining retail sales. You move into the dot-com bubble as banks tighten standards. Well, it sends retail sales negative. Bad news for retailers, and even worse, as you'll see, for the U.S. labor market. And now we see, going into the global financial crisis, the same net effect happens. as banks tighten standards, retail sales fall off the cliff. And mainly, you talk about because U.S. consumers tend not to have enough cash going into recessions to sustain their spending. So they rely on credit. With the absence of credit, spending goes away. Of course, you can guess what that means for the labor market. And you see that trend now, and we continue to hear about how we're facing a no landing, or at worst, a soft landing scenario. But when you look at the retail sales data, you really don't see that at all. And that's the problem, because what's going on at Target is going to affect every retailer across this country, and that's not a good thing. And even though inflation progress is moving sideways at the moment, which is good on its trend lower, most economists and executives expect price pressures to continue retreating, which I'll agree with, which could help support spending in the near term. Now, of course, we'll make the case that maybe that won't happen because there's a reason we're seeing inflation cool off, but we'll get to that in a moment. As disinflation is the word of the quarter in retail, that's a good thing for the consumer. This from Michael Fidelki, Target's Chief Operating Officer and Interim Chief Financial Officer. He said during an earnings call, and that's not necessarily a good thing for consumers at all, because what he's missing here is that it means demand is coming down, and that's bad news for retailers. The only way this is good news for consumers is if price pressures continue to fall because the supply is rising. The issue here is demand is getting crushed in a big way. That's a problem. But one thing that is a good thing for consumers as we talk about retail, that's retail trading, that is. And of course, many of you know that we have some reports to help you be a better trader. We put the probabilities in your favor. I want you to think about this. Check this out. Let's look at our reports. We have a CTA Timer Pro. Now, we look at the machine positioning every week. We talk about this on our Sunday show. But when we look at it, we run a historical overlay on our reports. So we show discrepancies. That gives you the advantage as a trader to find these dislocations and take advantage of those trades. We give you a report every day. We show you the machine positioning. We show you the hot ones to trade, and we help out with videos showing you how to do it. Now, maybe you like to trade the technicals, things like the RSI and the MACD and all those other technical signals. The one thing you find a big problem with, you get in late, you get out early. We have a proprietary signal that we add to all that, smooth the report out. Again, you get a report, you get the videos, we show you which ones to trade. And many of you ask, Steve, do your reports really work? And the answer is they do, and in a spectacular fashion. Check this out. I've been running a report of all the trades and will continue to do this between February 28th and March 8th. I took the very first trade each report did. So if it had a successive trade later that week, I omitted it. I put down a buy it open for every one of them. It generated 34 trades between the two reports, 26 up, 8 down, and as of market close yesterday, that's a 76% win rate. You think about this, you go to a casino, you don't get better odds at all. This gives you all the odds you need to trade successfully in a big way. Links in the description below for a free month. All my competitors and friends only give you 1 week on their reports. We give you a month. Why? Because we know you're going to make money. But who's not making money right now? That's going to be the retailers in a big way, because they're concerned about the health of the consumer, and they're suggesting that, of course, falling prices is good news. But what it actually means is demand is falling, and there's a good reason why. If we look at real retail sales now against average weekly hours, this is a production and non-supervisory employees, they're shown in red, and what you can see is that hours worked decline, well, so too does retail sales. Or when you see hours work plateau, well, so too does retail sales. And you can see this occur going into the dot-com bubble. You see it again during the global financial crisis. You can even note during that kind of, what looked like we're headed into a global recession between 2014 and 2016. Why? Hours worked were flatlining. You notice retail sales weren't moving, and now look, we see retail sales headed down. Why? Because hours work continue to fall. Everyone fixates on the average hourly earnings, which we showed you in the past, goes up even during times of recession. But one thing that changes is those hours work numbers. That means demand's coming down. What we really want to have a winning economy is supply actually go higher to meet and exceed demand. That would bring inflation down. The other way you do it is you crush demand. That is not a good sign at all. In fact, some Bloomberg's economists echo this by saying other aspects of the print showed only mediocre or moderate improvement. That's further evidence that consumers are running out of spending runway as they exhaust their savings and remain cautious about borrowing. Well, they're not just cautious about it, they can't get the money with interest rates still high. Of course, the interest rate market is going to cause a problem for retailers in a big way, and they're going to be screaming. But what happens now, as we look at the data, we see that real retail sales are negative. That's a problem, and we're seeing consumer demand fall. And all of this for retailers tells us bad news is coming, particularly as we know that the government appears to be fudging once again the weekly unemployment claims. Here over to Zero Hedge, as they know, jobless claims data goes from sublime, well, to ridiculous, because remember, this year alone, we've seen massive announcements of layoffs coming, but yet the data doesn't show it at all. In fact, the number of Americans filing for jobless benefits for the first time last week dropped to 209,000, with a non-seasonally adjusted number tumbling to around 200,000. How is this possible, you may ask? Well, we'll show you as New York State claims its jobless benefits rolls collapsed last week. In fact, if you lived in New York and looking for a job, it looks like you got one, no problem, because New York accounted for 99.75% of the weekly change in initial claims across the entire U.S. As you can see on this chart here, talk about something that doesn't even look like it belongs on the chart. Again, it suggests that everybody in New York that wanted a job and then some got one. But why do we continue to see this? Because it's simple. If people believe that the labor market is strong and there's jobs out there, they will go out and get one. And eventually, people will spend as if there is a job out there for them. That all means you see the economy start to increase. You see then employers want to add to their ranks. But the problem is, we're seeing the war numbers, they're rising, and that means, of course, the government's going to have to change its tune on its numbers before long, because a WARN number is a Worker Adjustment and Retraining Notification Act. This is for larger employers. When they want to get rid of people, they have to notify the government. Now, keep this in mind. When these notices go out and people lose their job, a lot of them don't just hit the unemployment line immediately and go file for claims. This is why they don't show up in the data immediately, because if you get a severance, maybe it's 3 months, 6 months, who knows how long, well, you're going to draw your severance, and then when that expires is when you hit the unemployment market. The government's hoping here is that people see that the labor market is strong and those workers that are losing their jobs on severance get back into the workforce. The problem is, if there's no jobs out there for them, that's a danger sign. Well, that means initial claims are going to spike in a big way. And as a reminder, if you doubt the accuracy of the Biden administration's data, here's what the most recent FOMC minutes said. Quote, while the recent trends prior to the meeting had been remarkably positive, Fed officials judged that some of the recent improvement, quote, reflected idiosyncratic movements in a few series, in quotes, suggesting that even the Fed's not buying some of this data. And of course, that suggests that we shouldn't either, and for good reason. Why? Here, what we can note is while initial claims stay relatively low historically at 209,000, what we can see is continued claims are now ticking back up to 1.811 million. What this suggests is that people that are losing jobs, about equivalent amount are finding work. The challenge is that people that get stuck on unemployment for extended period of times, it's only a matter of time before they start to cut their spending. Now, initially they may continue it because there's optimism they'll have a job, but the harder it gets, the longer it goes, the more their spending gets cut. And that is indeed a problem for the economy. And we think about retail sales here, we'll come back to that, because if retail sales go down and hours worked are getting cut, which validates that people have less money to spend when they go shopping, well, what does that mean for retailers who are going to start getting squeezed at the margin and need to make sure that Wall Street's happy with them? Well, it means they've got to cut. And sure enough, we look at, of course, the labor market and what its impact is and why this means retail sales aren't going to get better anytime soon. As we look again at real retail sales, that's inflation adjusted against continued unemployment claims in red. And even though we're only at 1.811 million, which again, historically is rather low in terms of our economy, but high compared to the 1.2 million we saw before. What this suggests is that small impact of about 600,000 more people from the low that are on unemployment. Look at this. The difference is retailers are feeling the pain here, and that means any chance that we're going to see a no landing or soft landing, at least let out of the retail sector, doesn't appear to be the case. What we really need to see is these continued claims come down in a big way. But will that happen? Well, it's highly unlikely because it appears the Fed is not only going to crush the labor market, they're going to crush a lot of retailers. The bond market's validating this in a big way. As we can see, Treasury yields reach weekly highs as inflation data disappoints. Now, this is pretty funny just based on the headline from the simple fact that the Fed doesn't really price the funds rate around inflation. That's just their talking point. This is what they tell Congress. This is what they tell the American public, but this is not actually how they set policy at all. So the fact that the market's reacting this way when they can't see that consumers are hurting, well, that's a problem. And while yields climbed only as much as 5 basis points, the 2-year note, more sensitive than longer maturities to changes in monetary policy outlook, topped up at 4.66%, the highest level this month. And initially, the market response to February producer prices was muted. We'll get to that in a moment, as the inflation data were counteracted by retail sales gauges that were weaker than expected. Now, you think about, again, why interest rates are a problem for retailers here, because how do Americans spend money? They don't typically just take the cash they have that's in their bank account that they made from their wages and spend it. No. What they do is they buy things they don't need with money they don't have. This is just how our economy works, and what Americans love to do is buy things on credit today. Well, that's a problem because the bond market means there's a lot more pain for retailers in the future, and if real retail sales don't turn positive, it means there's going to be more layoffs, at least at the retail level, and that means bad things coming for the economy. Here again, we look at real retail sales now against the 2-year Treasury yield, and I want to point out that when you see a deceleration in real retail sales, that usually is matched by a decline in interest rates, and it would make sense because if demand is going down here, which was exactly what we're seeing, then how do you juice demand in a debt-based economy? You bring interest rates down. They have to come down because and far enough that consumers say, hey, you know what? I can afford now to borrow money and go buy those things I don't need. And sure enough, that's why we see this relationship. You can look back to 2000. You can see a deceleration in real retail sales. And what do you have? A decline in 2-year yields. That happened again heading into the global financial crisis. And then you look now and you see, wait a minute, real retail sales are negative, and yet the market and the Fed really believe that interest rates need to stay higher here, and what that's only going to end up doing is crushing retailers in a massive way. This is going to put them in a position that in order to survive, they're going to have to lay people off, because all this is suggesting is demand is going to continue to get worse. The notion that we're even remotely experiencing no landing, or even better, a soft landing scenario, if we look at how bad the data is, there's no evidence of that. What we should see is real retail sales rising here, and that's not happening at all. And one of the challenges is that's going to lead to a problem for manufacturers that we just saw manifest in the data today. That doesn't look good for the labor market either. As U.S. producer prices jump, adding to signs of persisting inflation, this isn't a good news, because what I wanted you to see with the retail sales data was demand is coming down. And that means, of course, if there's an issue on the manufacturing level that's driving prices up, that means they get squeezed at the margin. And right now they're under big pressure to drive those earnings in a way that Wall Street will be happy with. And if they can't, well, there's only one way to cut the cost in a big way, and that's get rid of employees. As the producer price index for final demand increased 0.6% from January, the gauge rose 1.6% from a year earlier, the largest annual advance since September, suggesting that inflation is getting back into producer prices at a time demand is going down. And here you can see there's usually a strong link between final demand, shown in red, and the consumer price index, shown in blue. One of the challenges challenge is you tend to get in recessionary territory when you notice that demand is exceeding, of course, or cost is exceeding demand. In this case, we see producer prices rising. We're not seeing consumer prices rising, and we're not likely to, as Target noted, because, of course, this inflation is starting to get into the system, and it's all happening because workers are seeing their hours cut because demand is going down, and this slowly back feeds into the economy. And again, many people say, why is this happening faster? The bigger the economy, the slower this happens, and then all of a sudden, it'll happen all at once. The pickup in cost pressures at the wholesale level illustrate an uneven path for the Federal Reserve policymakers seeking greater progress on their inflation fight. Consumer price data earlier this week showed an underlying inflation exceeded forecasts for a second month, reaffirming expectations that the Fed will be in no rush to reduce rates, which is true. We'll hear from the Fed next week. It's unlikely they were going to cut rates at this time. The market was hoping that they would suggest they'll cut by summer. We're going to suggest that based on the trends in the labor market, they are likely to, but in the short term, I want you to see the Fed really doesn't react well to inflation. In fact, we can go back into the late 80s. They were cutting ahead of a decline. In fact, inflation was rising. They were cutting rates. You can see going into the dot-com bubble, they were cutting rates while inflation stayed elevated. Here again in the global financial crisis, inflation was rising. The Fed was cutting. Now this time, inflation's coming down, and they insist that rates need to stay high. Well, if they're hoping to realign supply and demand of the economy, they're doing it wrong because they're going to crush demand, which means, of course, retailers are going to be hemorrhaging. And when they start to hemorrhage, more people at the unemployment line. And when that starts to accelerate, well, the whole economy goes with it. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.